Hi everybody, this is Paul DeVierno speaking to you once again about U.S. financial markets. Since I spoke to you last week, the S&P 500 is up 1.3%. Year to date, it's up 4.5%. And in fact, last night, Tuesday in the U.S., the S&P 500 closed at an all-time high. To put that in perspective, how good a return that is so far, at the beginning of the year, most Wall Street strategists were kind of forecasting a return for the S&P 500 on average of about 9 or 10%. So here we are on February 19th, up 4.5%. We've already had half of that returns, and there's a lot of months left to go in the year. One of the things that I've been saying on these weekly presentations is I thought the U.S. equity market would be very resilient to bad news because U.S. companies would be reporting such strong fourth quarter earnings. As it was, U.S. companies reported even stronger earnings than I expected. According to FactSet, year-on-year earnings growth for the fourth quarter of 2024. Those are the earnings that we just finished hearing from U.S. companies. The year-on-year earnings growth is 16.9%. That's a very high rate of growth. Normally, S&P on average earnings growth is about 9%. One of the things I said last week is that with earnings seasons sort of running down, and now we're clearly at the end of earnings reporting, we wouldn't have that sort of positive influence on the U.S. stock market, and perhaps we become a little bit more vulnerable to bad news. Well, we're not seeing any evidence of that. Last week, we had a kind of a bad CPI number, a bad inflation number from the U.S., inflation running hotter than expected. That means that the Fed is less likely to cut interest rates. And of course, like I said, the S&P is up 1.3% since last week. We're at an all-time high, so it blew that off. And even last night, U.S. stocks went up, even though President Trump started making some comments about some new tariffs coming maybe later this week. So the market remains very resilient to bad news, and to me, that's a tiny bit surprising because you would think that it would be a little bit vulnerable to bad news because U.S. equity valuations are on the high side. And if you had some bad news, when stocks are already high, they would come down to normal, and that would be a big drop in price. But nevertheless, bad news doesn't seem to be affecting this market. One other thing that you should point out is, even though I'm kind of saying how well the U.S. market is doing, it's lagging this year. It's lagging many other markets in the world. Last year, the U.S. was really a leader, but like, for instance, this year, the Hang Seng is up 16% or something like that. European stocks, if you look at like the pan-European Euro Stocks Index in euro terms, that's up about 9%. So the U.S. market, although very strong, it's underperforming those other markets, although their strength is a little less surprising because they're starting from a lower point. Their valuations were not so high at the beginning of the year. Let's take a look at some of the recent market news we had last night, just so I can add my little 2 cents on it. We've seen the share price of Intel, which has just been a terrible stock for many years, start surging this month. And the reason it's been doing that is there's strong rumors that perhaps there will be some sort of takeover bid for Intel. As part of that bid for Intel, the rumors say that TSMC, Taiwan Semiconductors, may wind up buying Intel's foundry business. Could that be true? Sure, it could be true. But from my experience, those are not good transactions. The Intel foundry business is clearly second rate. And in the past, whenever you see a company that's renowned for doing a first-rate business and they buy a second-rate business, your immediate reaction is, oh, well, they can turn it around. They have the skill, they have the know-how. But, there's plenty of examples of things like Mercedes purchasing Chrysler in the US. That was a bad result. I think you could do a long list of times where it was just a mistake for the really well-run company to believe that it could take over some facilities that were not so good and immediately turn them around. I'm going to finish up by talking about gold. First thing I should point out is when I spoke last week, I said, oh, gold has moved so high, I wouldn't be surprised if some profit taking came out in gold after the release of the US CPI number. And although the CPI number, I wasn't really expecting it to be hot as it was, but nevertheless, gold did react badly. It did have a good drop. And the good thing that I said on that was, oh, if that happens, that'll give the gold bugs who are listening to this a chance maybe to buy gold at a cheaper price. And that was perfectly correct. Since then, gold has rebounded, and although it's not at an all-time high, it is just a whisker away. When I was doing my webinar last night, I had several questions about whether I think gold would go to $3,000 an ounce. And I kind of shuffled on that answer. I said, well, we're so close to it. If I said, yes, it will, it's not much of a prediction because we're getting very close. So you can either look at that $3,000 as a barrier that gold will have trouble breaking through. But my bias would be it's just a magnet. We're so close to it. Gold's just going to have to go there. So anyhow, that finishes my talk for the week. I'll speak to you next week.